Friends, I am Sharad Kumar Revatkar. I am retired from Dena Bank after putting my 39 years of service. I retired as Chief Manager in erstwhile Dena Bank, now Bank of Baroda. Now, with the help of this YouTube, I am going to tell you about the Basel Accords. Basel Accords are set of international banking regulations developed by Basel Committee on Banking Supervision (BCBS). Now, why these Basel Accords are implemented as Basel 1, Basel 2, Basel 3? The reason is bank is an financial intermediary accepting deposit for the purpose of lending or investment, and while doing this, banks are facing various risks. So it is important to study the risk. What are these risks? Because if banks are not addressing this risk, bank may face a problem of failure, and banks are taking deposit from the depositor. It is the utmost duty of the banker to safeguard the interest of stakeholders, depositors. So friends, before we discuss Basel 1, Basel 2, Basel 3, and what is the difference between Basel 1, Basel 2 and Basel 3, I think is very much important to discuss first a risk, what type of risk banks are facing while doing the role of financial intermediary. As I told you, risk is inherent in financial intermediation. The definition of risk connotes probability of loss or damage. Technically, risk is defined as the threat that an event or action will adversely affect organization's ability to achieve its business objectives and execute its strategies successfully. Now, there are various types of risks: credit risk, interest rate risk, liquidity risk, market risk, off-balance sheet risk, technology risk, operational risk, foreign exchange risk, and now Basel III have introduced a new risk, that is systemic risk. Now friends, we will just discuss what is credit risk. Friends, credit risk is the possibility of losses may arise due to inability or unwillingness of a borrower or counterparty to meet commitments in relation to lending, trading, hedging, settlement, and other financial transactions. Simple, I will say, when you give a finance, there is a probability that borrower may not pay in time. It may be willingly or unwillingly. Now, second is interest rate risk. The rate of adverse movement in the net interest income on account of movement of interest rate. Example, your interest expenditure have gone and interest income have come down. And this means a mismatch, you can say it is a interest rate risk. Now, liquidity risk. Bank is not in a position to make its repayment or withdrawal and other commitments in time. I will simply tell you, suppose you have taken a deposit of 100 crore and you are not in a position to pay back on maturity date or as and when demanded. This is known as liquidity risk. Market risk, bank is having the assets and liabilities, and the adverse movement in the market rates affects the face value of assets and liabilities. Simply once again I will make it easy. You are having assets and the value has gone down, whereas the value of the liabilities have gone up. This is your market risk. Now, off balance sheet risk. The risk incurred due to activities related to contingent asset and liability. Technology risk. Why institution makes the investment in technology? More particularly for saving the cost. When investment in this do not give anticipated result or savings in cost. Operational risk. The risk of direct or indirect loss resulting from inadequate or failed internal processes, people or systems, or from external events like breakdown or failures or power cut. Systemic risk. Basel III have introduced this new risk. Systemic risk means what? It refers to the risk that a financial institution's failure or distress could trigger a broader instability in the financial system, potentially leading to widespread economic harm. So friends, in this video, we have discussed various types of risks. Friends, risks are internal also, risks are external also. Internal risk means the risk which is in your hand, you can address. And external risk means the risk which is not in your hand. Like there is a failure, there is a earthquake, there is a change in government policy, there is a change in foreign policy, etc. The risks which are in your hand, which you can address, that is internal risk, and the risks which are not in hand, you cannot address, are your external risk. So friends, in the next YouTube, we will discuss Basel Accord. Mainly in the next this one, we will discuss Basel I and Basel II. Thank you very much.